everybody. Kurt Henry here, mortgage broker at the Mortgage Center. We are your go-to mortgage broker in the Durham region, and this is a weekly mortgage market update just to let you know what's going on in the mortgage market. So we know there's been some bank failures in the U.S., and that has resulted in some downward pressure on some of the bond yields, and that has resulted in downward pressure on some fixed mortgage rates. So fixed mortgage rates have come down in the last few days. Some of them, not all of them, but some of them have. So if you're looking at, buying a house, getting a pre-approval, refinancing, or renewing a mortgage, now's a good time to talk about it because we can get a rate hold. The key to managing volatility in any market, in other words, the mortgage rate environment right now, is mortgage rates going up and down over the last little while. The key to manage that is to get a rate hold. So for instance, as rates have come down recently, we get a rate hold on that for say 4 months. That way, if rates go up in the next month or whatever that might look like, then at least you have a rate hold when the rates were lower. So feel free to reach out if you have any questions on that. Other thing I wanted to mention is the idea of cash flow. So cash flow is on a lot of people's minds these days. It's basically looking at the money coming into the household and the money going out of the household. When cash flow gets tight, in other words, the amount of money coming into the household, i.e. your income, versus the amount of money going out of the household, i.e. monthly payments, when that gets tight and there's not a lot of extra cash, sometimes people look at the interest rates on their debts, and they think that the key is the interest rate to make it better. And I'm here to say that that's not always the case, and I'm going to give you an example. Let's just say somebody has a $35,000 car loan. Let's say the interest rate on that car loan is 7%, and let's say it's being paid off over a 5-year term. The payment on that car loan might be somewhere around $691 a month. But if they were looking to improve cash flow and they can't afford that $691 a month payment, one of the ways they could look at improving cash flow and decreasing their monthly payment is if they were to take that $35,000 car loan, if they restructure it into a higher interest loan, instead of 7%, let's say they put it into 12%, and it's an interest-only loan at 12%, the payment would be more like $350 a month on that loan, instead of $691 a month. So in other words, by taking the loan, putting it into a higher interest rate, and restructuring it, it's possible that it might decrease the monthly payment. In that case, it decreases it by half. Now, over the long term, that's not the best approach, but if the goal and the need is to improve cash flow in the short term, there could be a solution to something like that. Anyways, that's where we come in. If you have any questions on that kind of idea, feel free to reach out and we'd be happy to help.